on this very special conversation with the top team or the top think tank at Citi. They join us every quarter to talk about what is their view on the rest of the year, arguably the next 18 months in today's case. So Surendra Goyal, Head of India Research at Citi, Rashi Chopra, Director of India Metals and Cement Research at Citi, Kunal Shah, Director, India Banks and Financials Research, and Ashish Kanodia, for the first time on our show, Director of India Consumer and Retail Research. Lady and the gentlemen, thank you so much for joining me today. Really appreciate your time. Well, it's exciting times because with the good news come the question that, oh, what if there is a demand postponement? What if there is no resolution around the geopolitical stress, but at the same time, there are new avenues of trade opening? So Surendra, pack all of this for us, and not over the next 27 minutes because it could take that much time, frankly. But tell us, how do you think about all of this?
Yeah, okay. So first, thanks for having us on the show. So see, the way we think about it, I think on the demand side, I think there has been a lot of stimulus in some form or shape, right? Direct taxes, now GST rationalization, you had interest rates being cut, and so on, right? So all of this adds up to quite a substantial stimulus as far as consumption is concerned. Timing, obviously, near term we'll need to see, because there is definitely a chance that some of this consumption, people will want clarity on GST rates, etc. So that, but from a full year perspective, or say next 12-month perspective, I think it should still help demand, because there is a significant amount of stimulus which has gone through. Okay, and like if you look at the first quarter earnings, they were broadly in line, I would say. Like if you look at BSE 100 EBITDA growth, it was high single digit, profit growth is around just about double digit, which is not great, but it's not weak either, like particularly in the context of where expectations are.
Right.
Okay, and like from a market construct perspective, the market has seen a significant underperformance this year. If you compare it to the EM index, India has underperformed almost 20%. Valuations are now in line with average in terms of the premium to EM. I think that is where we are set up. So there are quite a few things which look reasonably well set. But as you rightly pointed out, I think there is still the uncertainty of tariffs, and that's a very difficult one to call. Right? So that uncertainty definitely is a near-term overhang. And I think that in some ways could decide which way the market goes. So our view is a lot of other things are set up quite well, but that's still a overhang as far as the markets are concerned.
Okay, if we were doing this post-August 27th, I mean, maybe there was some more clarity, but since we are doing it ahead, I'm asking you to hypothesize, Surendra, and tell us that let's assume there is no resolution, and there is this additional tariffs or what have you, or we have 25% bare minimum, and then the additional as well as stuff like that. But at the same time, there are new channels of trade opening. I mean, I don't know how much this India-China bonhomie moves ahead, but let's assume it does for whatever it's worth, right? And these benefits of GST and the stimulus, etc., all of that comes into effect. From an earnings perspective, from a markets perspective, is it a big hit or is it a digestible hit? How would the markets think?
Yeah. So see, I think there are 2-3 things to keep in mind here, okay? Firstly, trying to think about that situation, there are a lot of moving parts. Okay. Because even after August 27th, I don't think it's like you have certainty immediately, because a lot depends on how Russia-Ukraine war, like the progress on that. So that's unknown, and which is why I think there is still a chance that you may not have clarity. And I think at any point of time, the market will still possibly feel that, let's see, maybe it will get resolved. So that uncertainty is likely to linger. Now, second part of your question, earnings impact. See, if you're looking at a large cap index or even say BSE 100 kind of an index, you think about which sectors are getting impacted. The exposure is relatively small. Okay, so we are not expecting a meaningful impact as far as earnings are concerned, because you have maybe a few auto parts companies, few chemicals companies, right? Because the bigger exporters, IT, to some extent pharma, I don't think they are anyway impacted by this incrementally. So the earnings impact is likely to be lower, but I think the uncertainty impacts the multiple. The uncertainty impacts the attractiveness of the market versus other relevant peer group markets. And that is what is the issue here. So that is what we are kind of saying, that is what is kind of constraining upside, But otherwise, the market looks reasonably well set on a lot of other factors.
Okay, and therefore, just extending this point, on the counter side, if indeed we see let's say, definitive resolution or remarks around the resolution, right? Does that open up upsides for the market?
Yeah. So yes, I think that it has been a big overhang, right? So if you think about it, like in 4 or 5 months, we have gone from an investor view that India is going to be relatively well placed as far as US tariffs are concerned, to India being impacted among the most. So that's been the shift, and that's definitely something which has been an overhang for investors. So to that extent, if clarity emerges, it gets resolved on a favorable basis, definitely from a valuation multiple perspective, it should be a positive.
Got it. Well, and I'll come to IT as well, because we analyze that the kind of selling that's happened in IT. And Surendra, you are kind of a bit of a, not a lone voice, but one of the people who's still sticking to the point about, because we read your report this week, right, about multiples. So we'll come back on IT as well. But if I can go in this order, sure. And Kunal, maybe a sector which is relative to cement, relative to discretionary, maybe a bit less uncertain around GST rates, so on and so forth. So you could argue that finances will also suffer from it. But how do you see both the earnings and the multiple argument for BFSI currently?
So when we look at it overall in terms of the earnings trajectory, any which ways, because of the pressure on margins, the expectations were set quite low overall at the PPOP level as well as at the PET level. However, there has been a great support which has come from treasury side. This quarter as well, we saw that overall earnings for entire coverage universe was higher by say almost 3 percentage points than what we expected during our preview. And both with respect to GST as well as tariff, there would be a second derivative effect. No doubt on GST, it will be like more with respect to in terms of the credit demand eventually as to how it would boost, and maybe in the interim you can see some kind of a deferment in the purchases which can happen, which can delay a bit of credit offtake. But all hopes are now on the second half that we will start seeing some revival on the credit side. So if GST cuts really lead to some kind of uptick in the volumes, it could help the overall credit offtake. And on tariff, I think it's like a second order derivative effect, as Surendra was also highlighting. Maybe we have looked at it in terms of what are the bank's exposure to various export oriented industries. And across the board, it doesn't seem to be more than 3 to 6 odd percent, okay, across the entire banking sector. So it doesn't seem to be too significant to have any kind of impact as such, particularly either on the demand or on the asset quality side.
Okay. The other question, Kunal, was that when the rate cuts came into being, almost everybody unequivocally said instead of banks, look at NBFCs as the pocket of call, right? I'm trying to understand from here on right now, from where we are right now, looking at the earnings plus the rate cut impact, etc., do you reckon you would want to take NBFCs over banks? And if so, what's the pecking order there?
So again, our call has been not NBFC as the entire sector or subsector, okay, but we need to look at it maybe in terms of the segments where most of the NBFCs are present, because in a rate cut cycle, if you look at it, prime housing financiers, they don't gain a lot, okay, because whenever banks have to cut the rates, they immediately have to pass it on, and it is margin dilutive for them. So it depends in terms of what kind of pricing power do you have, okay, so that you can retain some part of the funding cost benefit and you can show some improvement on the margins. So players wherein maybe there is a good pricing power, they would report a relatively better margin trajectory. In general, eventually at the start of the rate cut cycle, or wherein there were expectations of 100 odd basis points of repo cut, I think that was any which was getting built into the NBFC's valuation. We have seen many of the NBFCs outperforming as well. But eventually, when you saw in terms of the numbers which have come out over the past couple of quarters, there has been some downward revision on the growth guidance. Okay, there has been some pain on the asset quality side. So eventually, earnings were not catching up with the expectations purely on the rate cut side. So you need to look at it in terms of how maybe margins would help in terms of the overall earnings trajectory. What is the growth outlook, and maybe who is better able to manage the asset quality trends. So few pockets, we have already seen some newer pockets of stress emerging in the first quarter. when you look at it, say people have talked about MSME, retail CVs. Earlier we were talking only about personal loans, credit card and MFI, but there are like a couple of more segments which have got added. And if there are NBFCs which are more exposed to it, I think we have seen the underperformance over past 1 or 3 odd months in those stocks.
So what's the pecking order, just before I move?
So we like, so when you look at it in terms of like within the NBFCs, we like Shriram, and within private banks, we like HDFC.
Okay, and I'm going to come back to the banking side in a bit. But Rashi, get you in on this conversation, and good talking to you after a couple of quarters. But you're in the thick of things because both the sectors have so much relevance. I mean, and I will start off with maybe cement, if you allow me, right? Arguably the sector of the quarter. You could almost make that call, right? What did you think about the earnings and the commentary, more importantly? And does this GST piece get the fly in the ointment, if you will?
So like you said, was the sector of the quarter. So we did know that, pricing...
With due respect to the others.
Pricing was strong, but I think it turned out to be a lot more resilient, from a pricing perspective than we had anticipated. Demand, of course, was weak, right? So I guess the industry managed to pull off those price increases. From an industry demand perspective, the general estimates are anywhere in the range of 2 to 4% for the last quarter. And we saw some of the larger players even reporting like a decline in volumes, but obviously the key highlight during this quarter was the whole pricing angle. And I think that feeds into the GST discussion in the sense that cement demand is not necessarily price elastic, right? And if you get that 28% going down to 18%, it's not going to push somebody to go buy a house or construction projects in that sense. But what it could possibly do is that in the very immediate, like the next 2 months until we have clarity, maybe the retail segment, the trade segment, the individual housing, that could potentially get pushed maybe, because again, it's not price elastic, but whatever demand is there, maybe those people would prefer to kind of pay lesser 2 months out. I don't believe that is the case for like the ongoing construction projects, larger houses, because there's obviously a construction cost, interest cost attached to that, right? So from a demand perspective, I think that's just a little bit of an impact. The question comes, does it help pricing? Does it give the industry pricing power? Again, the answer goes back to demand, because if demand is resilient at that point in time, then the industry will automatically have pricing power. Of course, that 1,000 bips, sort of leeway becomes more available to the industry. So bottom line, this whole thing is that, and which has been our base case, is that demand should generally be all right. 7 to 8% demand growth is good. There is, of course, supply coming in the market, and it is competitive even this year as we speak. But so long as that demand growth rate exceeds the supply growth rate, all should fall in place by and large.
Okay, but can companies just hike prices after doing a GST cut? That would be frowned upon, right, in some sense?
Unlikely at all.
That won't happen.
Because the government's idea is not really to kind of give the profit to the company, right? So I don't think they can do that immediately at all. But should demand be good over a period of time, they can eventually.
But there's
take
no
the price
loss
hikes.
because of that. But could there be a demand deferment? You don't agree that? In this case, it will not be the case.
There could be some demand deferment, like I mentioned, on the retail side, like individual home builders, some in the rural segment. But larger projects can't. There's an interest cost by and large which is attached to it, something which is already going on construction. You can't stall the labor for 2 months.
That's true. In which case, Rashi, I mean, based on, let's assume it's kind of neutral for your sector relative to maybe some of the other impacted sectors like the one Ashish will talk about. But based on the results and the commentary given and your hypothesis, what is your pecking order currently?
So we're sticking to Ultratech as our top pick. And again, it's the whole sort of demand thesis over here, because, pricing can be, cannot be. And so better to be with larger players who are who can cater to the demand growth, who are showing growth in terms of both CapEx as well as in terms of volume, and continuously working on the, on the cost structures. We actually have buys on pretty much most of our coverage. But, these smaller stocks we've seen, particularly the South and the East exposed stocks, have done really well in the last rally, because we saw that up move happening. Now prices have kind of sort of settled, If there's again this whole upside on prices moving, on prices again, then of course one moves to the smaller stocks. But as I see it, I think stick to the larger players preferably, with Ultratech being the top pick. In the very near term, and this is slightly more medium term, in the very near term, one could also look at Grasim, which may not necessarily qualify as a pure play cement company, but the holdco discounts offers a good opportunity to possibly look at that. It's crossed 40%, and the range has been between 30 to 60% historically, but I feel that holdco discount should start coming down as we get more and more positive on their paints operations.
Very interesting. Thanks so much for that. Now, Ashish, great talking to you. Thank you so much for joining in. Your sector is in the thick of things, right? So tell us a bit about how are you thinking about this and what is it that you are advising clients to do when I'm sure they're coming to you with a lot of questions around the space.
So I think, see, the demand across the wider discretionary is behaving in a very different way. At one side, you have like the cables and wires company who are seeing industry tailwind, very strong growth. Jewelry similarly has seen a strong growth for last many quarters, while on the other hand, apparel, footwear, QSR, in a way has been seen kind of a weakness in demand, being more discretionary in nature. And then on the other hand, if you look at durables, it was more a seasonal thing where this was a washout quarter, and that way we have seen industry kind of seeing a very bad decline. Yeah. So different subsectors are behaving in a different way, but it's more that within each of this subsector, you have companies which are taking more self-help initiatives and driving market share gain, growing much faster versus others. So for example, in cable and wires, if you look at Polycab, they have been gaining market share in the last 4 or 5 years. They have gained market share, good delivery on margins. Similarly, if you look at QSR, for example, that's one sector where we believe should be the biggest beneficiary of uptick in discretionary consumption, because it's a much lower ticket discretionary consumption, has been the first one to get impacted. And on that, if you look at Jubilant, for example, the way they have delivered the same store sales growth, they have been outpacing everyone. So it's more selective within each of this category, where it's more self-help initiative, because at a wider level, if you look at X jewelry and X maybe cables and wires company, demand has been slightly weak.
Oh, okay. Well, interesting. QSRs, you are probably, again, maybe a minority which is trying to think of QSRs positively somehow, but it's interesting to know that. I'm very interested in asking you about durables. We just had a conversation with Blue Star as well. Then they said that if the GST piece doesn't get resolved or doesn't get announced and known very soon, it could lead to a pause in demand. Now, my question is, Q1 was a washout. If Q2 is a washout, would people be wary, or would people say, okay, this demand postponement and not demand cancellation, and therefore you take it in your stride? And therefore, what's the pecking order there?
Sure. So I think what you said exactly, it's a postponement of demand in a way, right? Because durables is a non-perishable demand. We have seen that with jewelry as well. If you did not purchase a product right now, maybe because the season was bad, you would purchase it next year, right? So in a way, it's a postponement of demand, and we expect that a large part of demand will come back. Plus, you will have normally the base demand which should come through. Second thing, see, anyway, near term, there's no catalyst as such, because it's a non-season. You have 4Q and 1Q typically, which is the strongest season. So as we enter into 2Q and 3Q, it's a non-season, so there could be, it's very difficult to see how it plays out. Then this quarter again becomes interesting because you have an early festive season, and typically during festive season, some demand picks up because of various sales, etc. So that way 2Q would be slightly different. And then if you also extend this to a full year, you have a BE rating change coming effective January 26. And just before the BE rating change, because there is a price hike which happens because of rating changes, etc., typically channel would kind of build up inventory as well. So there are too many moving pieces when you really look at the next 3-4 quarters. But I think the bigger thesis here is that because it's a postponement of demand, you will ultimately have to buy the product. A large part of the consumers will end up buying the product. So that way, slightly from a medium-term perspective, it really looks interesting. And in that case, we like Voltas.
Okay, so Voltas, QSRs, Polycab, that's a gamut which is wide enough. Okay, great. Surendra, IT, let's briefly talk about it. You are one who's still staying, for lack of a better word, somber on that space. What would it take for you to turn constructive?
So that's been like a difficult question which we have been trying to answer for a while. I think, firstly, if you see a significant pickup in US or large US corporate growth, okay, so that I think could help, because obviously the sector has underperformed quite significantly. Expectations are also low. So if you get a growth pickup because the US corporate spending picks up, I think that could be one catalyst. Second is like so far, these companies have not really benefited like in my view at all or meaningfully from AI. Okay, so if you eventually have applications which start giving the industry meaningful growth from AI, I think that could be, and when I say like they have not benefited, there are pockets which have benefited. I'm not saying they have not benefited at all. But at the same time, there are parts of the business where there is significant productivity, which they have to pass back to customers. And I'm talking of a net outcome. So I think these are two things that we are really looking at. One is if US corporate health improves, spending picks up. Right now, what's happening is firstly, spending is what it is. And then within that, everything is getting diverted to AI infrastructure, preparation, whatever you want to call it. And like IT services at this point is not really a play on that. So those two things is what we would be watching out for like any kind of sign of turning more positive.
Okay, we have 3 minutes. I'll take very quick questions with all three of you. So Rashid, to you first. I don't know if you've done some work around rare earth because it's a very small bucket, but are there plays there? And if not, what stands out within the metals universe per se as one key thing to keep in mind when you're thinking of investing there?
I'll make it quick. So too soon for rare earth in India at this point in time. I think aluminium is the one that I'd probably say stands out. Aluminium, basically things like robotics, data centers, decarbonization demand, and all things like robotics, data centers, etc. They are all sort of power intensives. So they themselves are competing with the aluminium sector, which also, if you need to set up capacity, you need power as well. So from a demand perspective, you have demand coming up from aluminium, but from a supply perspective, it's quite constrained. And China has hit that, almost close to that 45 million cap on aluminium. So there's little visibility of some capacity getting added in Indonesia by Chinese players, but I think that demand will still possibly outpace supply. So that looks like a slightly more longer term, good commodity to play with. And that brings us to, Hindalco, of course, being like the lead over there. Of course, in the near term, we have some concerns around Novelis and, the whole impact of the tariff. But that seems pretty much priced in because we've seen the worst and maybe see that for another quarter or so. So kind of play aluminium and play Hindalco as the long-term theme.
Okay, nothing on rare earth, but aluminum and Hindalco kind of stands out. Okay, thanks for that, Rashi. Kunal, HDFC Bank, I heard you say, but that can't be the only one, right? There are a clutch of mid-sized banks. Then there are maybe the non-PSU small banks as well, which some of them have done good work. Anything out there which is the coverage universe, the commentary or earnings stood out for you or anything?
So clearly now margin expectations are getting set in. The way we need to position is look at who would be more defensive with respect to asset quality and who can leverage on any opportunities which come up on the credit side. And that's where maybe wherever you see a better visibility with respect to ROA, if they are able to manage both of these better, as margins are now very well known in terms of how it would pan out over next couple of quarters. I think we are also sticking to our preferences, looking at both of this aspect. And that's where apart from HDFC, if you really look at it on the mid-sized, we like RBL. So there we see like clearly by end of Q4, you will see the trajectory moving from 0.56 odd% to closer to like 1 odd% or so. So that's the preference out there within the mid-sized banks. And many of the smaller banks, when we look at it, it's like they are just coming out of the MFI cycle. We still need to look at it if maybe there could be any further worries on the asset quality side, because MSME business loan is something which is still emerging as a stress. And if they slow down on the growth, it might not be so exciting. Yeah.
Got it. Okay. Surendra, beyond these, I mean, autos or defense or infrastructure, anything that stands out for you guys as a house as we wrap up this show? I mean, what would you watch out for?
No, so see, our underlying theme has been good earnings visibility, okay, at reasonable valuations. So sectors like telecom, healthcare, those sectors still look pretty good to us.
Okay.
Okay, so if you look at like the overweights, we have like banks which Kunal spoke about. We have cement as an overweight, which Rashi already covered. Then you have telecom, healthcare, and some of the travel-related stocks. I think those are the three areas I would highlight beyond what we already spoke about.
Okay.
Which I think should continue to do well.
And should there be a resolution, you reckon that because of all that's happened, you might be constructive on markets at large as well over the next 12 months?
Yeah, so that's exactly what we wrote in the very recent note, that the setup looks pretty good. Okay, when you think about it, valuations, stock price underperformance. Domestic flows are still quite resilient. Foreign or in the EM segment, foreign investors have an underweight which is close to the highest in 20 years on India. Okay, so I think the setup is good. You have some of these concerns going away. I think the market should do well.
Okay. Well, all of you, thank you so much for taking the time out and being with us. Really special, Rashi, to talk to you after such a long time. Kunal, Surendra, always good talking to you every quarter. And Ashish, great having you for the first time. Looking forward to talk to you more often. Right. And viewers, that's the special conversation with the Citi think tank. Thank you so much for tuning in.